Toby, are we live?
We are live. How are you, gents? It's 10:33. We're running a little bit late. Apologies, folks. 10:33 on the West Coast, 1:30 p.m. on the East Coast. I've got no idea what time it is UTC, or it's like 3:30 a.m. Australian Eastern Standard Time, so I expect lots of Aussies on this one. How are you, gents? We've got a special guest today. Ian Cassel's joining us as a locum for Bill, who's having a break for a few weeks. Welcome, Ian.
Hey, it's great to be here. And I think I've tried to bring a 10,000 bots to the program today as well.
Yes. Yeah, I had one of my sons poke his head in. He's like, "That's not Bill." I said, "I know. Get out of here."
Sorry to disappoint.
Yeah, sorry.
What are we talking about today? I've got a little bit on Charles Devoe, who's sadly passed away, and then do you have any topics, Ian? Did you prepare?
There's a couple things I could talk about. I've been journaling a little bit on sort of some mental models for microcap investing, and I could share a little bit about that. I just started
that sounds good.
Thinking about it in the last couple of days. So
I'm excited for that.
What about JT?
I got a little mini veggies cooked up. It'll be on this
baby
Falconry.
Carrots.
Yeah, they're just baby carrots. Not even really cooked, actually, just raw.
It's the best way to have them.
Yeah, it is better. On a falconry term that might be of interest for everybody. So We'll get to that.
So very sad news today. We just learned Charles Devoe passed away. He was the founder and sort of the prime mover behind International Value Associates, I think, IVA. So I read a little. They announced that they were winding up their funds very beginning of April, and there was a long article written by someone who had been an investor and a supporter of theirs since their inception in 2012. And I read that article, and it was just it was an awful experience because it exactly mirrored my own experience as we've gone through the last sort of 10 years for value, in the sense that they've just struggled to find the kind of undervalued positions that they like. And so they've been extremely disciplined, and they've carried a lot of cash. And as a result, they've really underperformed. And I think that they looked at March last year as being one of those rare opportunities where you could deploy some capital and expect to get a pretty good return. And as everybody, sort of now knows, that they struggled to get the money deployed because it was a very sharp bounce and recovery to now new all-time highs. And value sort of has lagged initially out of that bounce. It's sort of come to life a little bit more over the last 6 months, and even the last month more so. What do you guys think about that? Did you have any thoughts?
I know when I saw the headline and I read a little bit about it, it's really hard to go a long stretch underperforming. And I know as a stock picker like I am, and I'm rather concentrated, call it a dozen positions, sometimes less, the more concentrated you are, the more likely you're going through some long durations where it doesn't feel like anything's working. And, that can be a really, really kind of negative spot to be in. And, back maybe 15 years ago, I was in 3 or 4 positions. Now I'm closer to a dozen, and some of that has to do with managing some capital as well. But, it really helps just to have something working in the portfolio, even if it's the smallest position in the portfolio. And it's something that I think it might not even mean anything to the returns. It might just be a mental lift that it gives, but it's something that I've thought more and more about over the last 2 or 3 years as well.
So do you actively try to put something in there that you think will be especially non-correlated with the rest of it?
I try, but it's seriously going back 20 years. It's funny, like even the portfolio today, I mean, we're rather diversified across different areas and sectors and industries, but it still is amazing just how sometimes it just all goes in sync. It doesn't feel like, it feels like they should be uncorrelated bets, but a lot of times you win and lose in bunches when you're a stock picker for some reason. But it definitely is helped by psyche, I believe, kind of just expanding the portfolio up to even a dozen equities. And then oftentimes it's that smallest 1 or 2, 3 positions that you have in the portfolio that end up outperforming, even the largest positions, because you've given them the mental space that they need to actually grow. You kind of give them enough space that they can stumble a little bit. You're not going to overthink it. And you're going to give them enough space to get overvalued a little bit. You're not going to sell them, So it's just helped me mentally, just adding a few positions.
One of the challenges is that businesses in an industry often get undervalued at the same time because there's some industry-wide issue, and so then you've got this problem where that to outperform you need to buy a few of these things because this is the rare opportunity they get undervalued. But then you're also taking on this now industry risk that if you're wrong, and so I've back tested this many times, and basically you get better returns if you're unconstrained. You can buy whatever you want, which means you get industry concentration. That's how you get the really good returns. But it's a double-edged sword. It cuts both ways. You end up being concentrated in for-profit education, which, that's a disaster because they all go to zero. So I guess it comes down to what are you trying to do? Are you trying to maximize your gains, or are you trying to minimize your potential risk? And I think I started out trying to maximize gains, and as I've got older, I've gone to minimizing the risk side of the spectrum.
How do you guard against that, Toby? I mean, you just kind of mentioned it. At certain time periods in the cycle, certain industries are going to be cheaper than others, and so all of a sudden you're 50% in gold miners or something. How do you guard against that? From portfolio level?
I have an explicit rule. Where I won't buy long. I won't buy more than 20% in an industry, and short, I won't do more than 10% in an industry.
That makes sense.
But that still hurts returns. That still hurts returns in a back test. It's just that I figure that's the sort of the most amount of capital I'm prepared to sort of tear up in any one industry. If it's real, and this evidently happens now. You get that. The for-profit education, they all screen really cheaply. They all look like really cheap businesses, but that industry was just, burnt to the ground. So you got to be careful.
Well, and I think it's also an area that we were talking about this a little bit before we came on the program today. It's even when you're looking at your cash position, if you're managing your portfolio, especially if you're more of a value or deep value bent, where you're waiting to buy once every 12 years when the market gives you that opportunity and that 60% drawdown, you're sitting there with 40-50% cash, and you're just waiting and waiting. Just that mental drain of, you wake up in a negative mood because you want the world to end so you can buy this stuff cheaper.
Yeah, I've been there.
Yeah, it's tough.
Yeah, and then you start bargaining with the universe that if it just crashes and let me get deployed, I'll never hold cash again. Give me chase, but not now.
That's it. That's exactly right. Yeah, I don't know if there's any really good answer to it. I've done a little bit of testing of that, and you can, whatever rule you come up with has failed because the market has got the market's got more expensive over time. Like whatever sort of fixed rule you applied has always sort of got out of sync because basically we're at essentially all-time highs now. So whatever rule you would have applied, it sort of forces you into holding more cash than you would otherwise want. There's never a really strong signal in there. So you test the other way where you don't hold any cash at all, and you invariably outperform. The opposite side of it, though, is that you get these bigger drawdowns. But then the immediate thought that comes to mind is that Buffett line about I'd rather a lumpy, I think he says a lumpy 15 rather than a smooth 12. And so that's like you have to make that explicit choice. Am I going to have the lumpy 15 or the smooth 12 or the smoother 12?
Yeah, but is it like the lumpy 15 and the smooth 2?
Well, on the other hand,
that was just you could get 6% in your treasury bills without breaking a sweat.
That's true. There's Seth Klarman out there who underperforms for the bulk of the cycle, except he's got a whole lot of cash. So when the market actually really does fall over, he gets most of it invested, and as a result, outperforms over the full cycle.
Yeah, I feel really bad for Devoe, because I think I know how he kind of got where he got. Like I think it started out with the things that you owned got fully priced in your opinion. And so you decided to sell them, and you had a hard time finding things to replace it with that made sense to you at these prices. And that sort of keeps happening and happening until before you know it, you're 40% cash and you're making a macro call now, even though that was not your intention when you started in the least. You were doing bottom up analysis. And before you know it, you've been in cash for a long time. And now you're fully kind of reputationally pot committed to cash. And now you really have to have that big crash before you can kind of get back to where you probably should have been all along, maybe. That's brutal. It's rough. I mean, I know because I'm speaking from experience.
I looked at the, before we came on, I had a look at the multiple website, which has got the Schiller PEs at 35.58 today. The 1 year PE, I think it was at like 42, something like that. Just absolutely bonkers. And then the 10 years at 1.58, which, that's up a lot over the last 12 months. But when you look at it in the context of that long run chart that goes back, there's nothing to suggest that experience is over either. We could clearly still be in that sort of downtrend that, maybe it looks like Europe, maybe it goes into a negative territory. That macro stuff is just, you give yourself the worst headache trying to solve that problem, and I don't know how to solve it.
I try not to think about it. But it's just, I'm a little bit. I don't spend too much time thinking about the macro. The way I think about it is on the micro level, just thinking about the businesses I own and can they weather a storm? Can they survive a COVID timeframe like last February, March, and throughout the year? And that's the only thing I can do. That's the only thing I have control over. Just trying to be, and obviously I invest a little bit differently than you guys, but just trying to find those unique growing businesses that obviously are small because I'm a microcap investor, but that can weather that storm. A lot of my filters that I use, they're there to kind of protect the downside as much as realize the upside. And so,
how do you think about valuation for those companies? Where does valuation come into it for you, and sort of what stage of the process?
I look at everything kind of through a 3-year lens, and this is kind of evolved over time too. It's funny when you think about the maturation of an investor. I think we've all kind of gone through similar maturations where when you first get into investing, you're just looking at fundamentals and financials because that's the only knowledge base that you have because you went through an accounting class or went to school, that type of thing. And so you're overly emphasizing the financials almost of a company, and because that's all you know. And then over time, you kind of start looking at different industries or different kind of sectors, and then all of a sudden, oh, look, I love this oil and gas sector. I just want to focus on this, and all of a sudden, you become kind of an expert in that area, and then all of a sudden,
and then you're out of business.
Yeah, exactly. Yeah, and it depends where you're at in what cycle. Then you're like, okay, well now I care about management. I didn't care about it before, but this is a new area. Now I'm going to dive into qualitative attributes of investing, start looking at leadership. I did that with Intelligent Fanatics, and you overemphasize that area. And then you go to growth. Well, let's just look at things that can grow 40% a year because growth can cure a lot of ills. If they overspend, who cares? They can grow, whatever the case may be. And so kind of you're always kind of going away from the mean, then coming back to reality. And I think all of a sudden, 20, 30 years later, you realize, all of those pieces are necessary for the investing puzzle, whether it's, financials, growth, valuation, quality, the management part of it. And that life's all about that journey, especially through investing. And that's kind of where I've been at too. I mean, even when I wrote 2 books on Intelligent Fanatics, I was probably overemphasizing the Intelligent Fanatic of the organization. I mean, the one key takeaway from the Intelligent Fanatics work I did was actually to pay less attention to the person at the top and pay more attention to the people they have around them. It's so
that's interesting.
And
why that? Why is that the key takeaway?
Well, because a lot of microcaps, they're just hustles. They're 1 or 2 man or woman operations that they can. And Brent Beshore talks about this as well, where they can take a company from 0 to 20 million in revenue, and then they become their own ceiling because they keep on having to do everything. And so I'm interested in finding the ones that can go from 20 million to 100, 200 million, and for that you have to put great people in place, put processes in place, put feedback loops in place that will allow you to spin that flywheel and get the business humming. And so, even a lot of the successes in microcap, especially in nanocap, a lot of them are just really glorified hustles. There's a lot of big moves of 10 million market cap companies going to 50 million, and that's a 5x. But that was just a business that went from 5 million in revenue to 15 million in revenue and earned 4 times more, and then that's all it ever is, And so anyway.
So it's like the difference between, sorry.
I was gonna say our processes are kind of like the blind man who's feeling the elephant, right? And we over-index to kind of whatever part of the elephant we've been touching recently.
Recency bias.
Yeah.
Yeah, it's the difference between an entrepreneur or someone's just had that singular kind of insight to like building a business that is, and that's quite a challenge, I guess, because there's lots of guys out there who'll come in and they'll pilot your business once it gets to a certain scale, like the mid cap and above, and they're like professional CEOs who know how to take something that's stable and then grow it stably. And there's plenty of guys who are entrepreneurs who can get from 0 to whatever, 20 million, say. But it's that putting all of the systems in place to get from 20 to mid cap or 20 to sort of solid small cap. There wouldn't be a lot of people around who've got that skill set, I guess, unless they've done it themselves. And then why would they want to do it for somebody else?
Yeah. Sort of the thing I like to see is, the thing I really like to see is the intelligent fanatics, somebody that had previous success, somebody that built up a business and sold it for 20, 50, 100 million. And now they're just using their personal net worth to kind of backstop this vision of a new company. They're bringing the band back together again, and they know what worked, they knew what didn't work. I love finding those, and I usually stumble upon maybe one a year of something like that. And it benefits it from the capital market side too, because this is a person with a personal net worth where if the company needs another 3 million, he's writing the check, or she, and so it cures a lot of ills when you find those kind of qualitative measures in a leader, in one of these small companies.
So you said earlier at the beginning, you're going to talk a little bit about journaling and some ideas that you've had. Just what function how do you keep your journal? What do you do for journaling?
Normally I just get up and just throw up on a page. Sometimes there's no rhyme or reason to it. Lately, I'm doing an interview in another week with Rohith, who has actually worked with me on Intelligent Fanatics. He's now doing some work for Manual of Ideas, and he asked me to kind of think about mental models for microcap investing. And it's an area that I've kind of written on and journaled about, sort of haphazardly over the years, but I wanted to put a little bit more construct to it. And so I've been thinking more about that, and kind of the two main, I don't even know if they're mental models. It's not like you hear Charlie Munger thinking about them or using them, but I mean, it's just kind of two themes of, I think the most powerful thing in microcap is when you can find a tailwind combined with scarcity. So when you find an industry or consumer trend or technological tailwind, and Josh Wolf would call this kind of a directional arrow of progress. I think we've probably heard some presentations he's done. When you can find something like that, and then when there's only 1 or 2 or 3 public ways to play that directional trend, so you're kind of, 1 million people want to buy something, but there's only 3 pieces of artwork out there, it just drives price, and that's the power of kind of scarcity.
This is your NFT portfolio.
That's what I was going to say.
It is, but
okay.
It seems like it's oversimplified a little bit, but those are the things that I generally try to find. There's things where there's a tailwind. It's just easier to row with the tide, as they say, and then also to pick the areas where the institutions are going to come after this tailwind at some point, and there's only going to be 2 or 3 ways for them to participate in it, and I want to own it before them.
That sounds like a pretty good pitch for Bitcoin.
Yeah, well, it's a little bit of the same. I'm trying to think of a good example I could give you guys. Maybe a good example.
Historical example.
A good example, I think. When did Facebook go public?
2013.
2012, something around there, right?
2012.
So it was probably like 2010 then. So social networks were becoming the rage. Facebook wasn't public yet, And there was this small website called kpasa.com, which was the only publicly traded social network that existed. And it was a small 20, 30 billion market cap microcap company. And it was a, Latino social network. And, I stumbled upon it. I met with management when they went to New York, and I was like, okay, this is an area that I think is going to get hot. It's the only one that's public. Eventually, there's going to be more that are going to come public, but I think that institutions are just going to buy this thing up because their investors will demand exposure to this ecosystem, whether it's just this one or two or three other ones. This thing's going to go higher. And sure enough, over the next 12 months, it went from like $1 to 12. Just in the back of just institutional inflows needing exposure to this, and eventually Facebook went public in 2012 or whatever, a year or two later. And then this company actually morphed and merged and became MeetMe. And I think MeetMe just got acquired for 500 million last year. So it ended up evolving into something else, still a social network, a dating app, more or less. But that's kind of a crude example, and that's not representative of great business either, but kind of just to give you an example of sort of that directional tailwind, and then there's only one or two ways to play that. But I think you can find things like that in microcap, in certain areas of the industry where it's going to be a place that's going to garner a lot of attention, and so part of my, I don't characterize myself as a momentum investor, but I want to find things that are undervalued that will get overvalued. And so that's kind of the metric that I look for, things like that.
I just stumbled onto MySpace Tom's, my original friend, MySpace Tom. I found his Instagram feed. It's insane. The guy's just been on holiday, been on vacation since he sold it. But that was a great deal. He punched out of that for 700 million to News Corp, and News Corp sold $2 billion of advertising. That Google paid them $2 billion to have exclusive advertising on it. So it worked out well for everybody there as far as I can see. But MySpace Tom gets ripped every now and again because, he's not Zuck. But then I look at his life and I don't think that MySpace Tom wants to be Zuck. I think he's
not
living his best life.
Congress and
no. He's just, he's got I think he's got a drone and he's got an interest in photography. So his Instagram feed just looks like a professional travel photographer's wet dream. Basically, it's incredible. He goes everywhere. Should we
just the one last one? I was just thinking about it. Probably another one that I think works really well is obviously something like Inversion, which Munger talks about. But I know, and I tweet about this probably 3 or 4 times a year, just about if you want to hold a multi-bagger, you have to hold a multi-bagger. And so if you want to find great companies early and experience that gain and actually realize that gain, you're going to have to hold these things. And that means you're going to have to go through the volatility it takes to endure that. And you're going to have 30, 40, 50% drawdowns. Case in point, the largest position in my portfolio right now, it's down 40% since the end of the year to now. And that hurts, but the business hasn't changed. It's just that it's, come off a little bit, fundamentals backfilling into the stock price. And that's just a big part of these things. But, I find if you want to hold multi-baggers, there's like 2 ways to do it. You either Chris Mayer coffee can them, either make them so small that you're not going to think about them almost, or the opposite side of that, which is make them a concentrated bet that you're going to know them better than most. And you're really going to have your pulse in that company where, you can hold through that volatility because that business almost on an intimate level. There's almost like 2 ways where you can do that.
Do you trim them?
It's interesting they're at opposite ends of the spectrum too, right? Like buy it and then just completely forget about it. Like, lose the account login or like know it so well that you mentally can handle the rough ride that you're about to receive.
Yeah, I don't think there's any right or wrong. Either one of those is wrong either. I've thought before about, I stumble upon ideas all the time that, again, this microcap investing the way I do it, it's not batting average. I'm not trying to be 10 out of 10. It's still 6 out of 10. And I'm not going to be right all the time on the things I think I know. And a lot of the ones that I maybe passed on end up being big winners. So, what is a coffee can kind of 40 company microcap? All right, I'm going to equal weight 2.5% across all of these things. How does that do over time? Obviously that looks more of like a venture bucket. But I don't think there's any right or wrong answer to it. It's more fits your personality, I think.
I have done a little bit of testing in that space, just because I'm interested in what happens if I just buy the list of the best, and on a very not a particularly strict valuation basis. Like, I'm just saying they need free cash flow better than the existing 10-year, and then there's some, you assume some growth. And I've found that the portfolios, like in any given year, you're buying 40 or 50 companies, because I think there's like 200 or 300 worthwhile ones globally. You end up buying 40 or 50 in any given year, and then a portion of them go to zero. And it's very, very hard to detect at the outset, I think, to eyeball them and work out which one's going to be a zero and which one. And then, some of them end up going up quite a few times. So that's, you do become, each little portfolio that you form in any given year, wind it forward 20 years, and it becomes concentrated. It's just unavoidable. You're going to have positions in there that go up 10, 20, 60 times in some instances, and they become material to the portfolio. And then you have lots that go to zero or don't go anywhere. So the portfolio sort of becomes a concentrated, high quality portfolio over time. It's just, you're really riding on a handful of, by that stage, pretty overvalued names. So like, you won't end up owning Netflix, and you got a big chunk of Netflix. Like, I don't know what I'd be doing with that if I was concentrated. It'd be very nervous making.
Not sleeping at night.
Not sleeping, yeah. So, but even not being concentrated, it still ends up being like 8% of the portfolio.
I was thinking about, what if there was sort of like an Ender's Game like layer between you and what was actually happening in the portfolio. So you're like picking names and you're overweighting this concentration, but what actually is getting done after that is like, oh, it's even position sizing it. It's it's holding for longer than you were going to. It's like, it's doing all the things that you kind of think you should be doing, but you are really too hard to execute because they're just too mentally painful.
Well, I don't mind that as an approach. I think you kind of get there with the quantity kind of, doing it explicitly from the outset.
But you have to watch what's happening on a day-to-day basis, and that can be painful, right?
Yeah, I think that's probably the solution, right? Just to forget about it. Once you've formed a portfolio, now that's the 2021 portfolio, and you're not allowed to look at individual names in it. It's just going to trade as a monolith. And then next year you're going to form the 2022 portfolio, and you're not allowed to look, or you're just going to torture yourself if you look.
Well, it's almost like the VC vintage. You're going to have vintages. Almost.
Yeah, that's exactly what it is. Who had the idea of they would trim their smaller positions? Do you remember that? Like, if it fell below some portion of the portfolio, 1% or 2%, I forget what the exact number was, but then they just sell out. Do you remember who that was, JT?
Yeah, the first person I heard talk about that was actually Mark Simpson.
Mark Simpson, yeah.
Yeah, in his book, saying like, once it falls below a certain level, like it's just a distraction for me at that point. I need to cut bait and find something else.
I think that's a good approach, because if it's a good company and it gets cheap again, you'll buy it again with a full size holding. I don't know what the level is. I don't know what the materiality is, but 1% suggests, if you got 50 stocks and it falls to 1%, it's basically halved.
Yeah. Math checks out.
I like the thought process though, Toby, and I think the first time I ever, he said it so eloquently, but Brian Ferraldi on Twitter, he mentioned, he had a tweet about that. If you naturally just let your winners run, they become more concentrated, and your portfolio becomes more concentrated in your winners, and that should be sort of your goal. That's kind of what you described.
The problem is, and this is the only thing that gives me pause, I look at it now and we're close to where the market is high. Everything's performed for a long period of time, 12 years of performance. What does that portfolio look like if you go through a drawdown? Would I regret, you had Netflix there, and you had, some huge weighting in the portfolio in it, and you knew it was overvalued. Why didn't you sell it at that point?
Yeah, it gets really difficult. I've had this same thought, just with kind of putting that to work even in microcap. Just kind of gets back to what I was saying about nano caps. A lot of them that are even hustles can 5x and are still a hustle. Same thing, a lot of the really big microcap winners, they went up 10x, but that's all they went up, and then they went down 50% and they stayed there. And so you don't want to just coffee can these things, and especially in the smaller realm of microcap, usually it's more obvious when something stops working, unlike a kind of a large cap, from a business level, and so it's stupid just to keep holding things aren't working.
Have you had anything that's like graduated to mid cap and then made it into large cap? Not necessarily holding it all the way through, but something that you were looking at when you started out 20 years ago, and now it's a big company.
It's a good question.
Little company called Amazon.
Yeah. But unfortunately, the Amazon only got down to like 250 million market cap, I think, kind of at the trough. And that's when nobody else, Bill Miller was the only one buying it. But
isn't your cutoffs like, what's your cutoff? Is it 300, or is that's the inflation adjusted number? That means it was like 100 back then or something.
Yeah, it probably was. Microcap's considered sub 300 million. It depends if it's in vogue or not. And somebody wants to make it 500 million or less, and they call themselves microcap.
Yeah.
It really depends.
That's a good trick. I just got to write that one down. Hold on.
Yeah. Under $1 billion. Okay.
But it's funny, like you go around the world based on kind of exchange rates. It's, a friend of mine, Sanjay Bakshi, who manages a fund over in India. It's like he's a mid-cap investor and his average market cap 600 million USD. And so it just
should be small cap here.
Yeah, it's just the business are just smaller, because of where they're at, probably their economic cycle and just the maturation of their economy.
I think that's true globally. I think Australian businesses tend to be smaller. The US businesses are kind of unusual that they get so big. Like $1 trillion. I'm struggling a little bit to wrap my head around that one. And there's a few now. Like it's not like that's a new thing.
It's ridiculous. It's annoying to me as a microcap investor and it's why the market's probably as high as it is when you look at, 7 of the top 10 largest companies in the world are technology companies. Oh, and they're all growing. They're still growing 20 to 40% a year. They're the largest companies in the world, growing 20 to 40% a year with 30% EBITDA margins. It's like, okay, with 0% interest rates. Yeah, I can see why with the market cap, weighted indices pushing them higher. Yeah, I could see how that works,
I'm surprised the indexes look as stretched as they are, because they make up such a big part of the index, and they're all free cash flow positive, growing really quickly, really good businesses. And it's like, it still means the rest of the index is kind of not really pulling its weight.
Yeah, fundamentally speaking, you mean?
Fundamentally speaking, yeah.
Yeah. Yeah. What are all these other laggards doing?
Trying to appeal to deep value investors or something like that.
Yeah, I guess so.
That's not a good place to be.
Melting ice cubes.
Do you want to do your baby carrots?
Sure. Yeah. Ian, did you have any other mental models you wanted to drop on us?
That's enough. Yeah.
Okay. I'll save some for next week.
Yeah.
Save some for the podcast we're supposed to.
Yeah, exactly.
Yeah. Exactly.
Talk about it.
Yeah. Just show up there. I've got nothing.
Yeah. Just listen to this.
All right. So I came across, one of my friends told me about this idea that's actually from Falconry. And it came originally, I think he learned about it from Yvon Chouinard, who was the founder and driving force behind Patagonia. Right. And I don't know if you guys know much about him, if you've read his book, Let My People Go Surfing. Just a terrific book, but and just like the culture that he built is so unique. And just, I'm very, I don't want to say envious, but I think he really did a lot of things right on a long-term sustainable business standpoint. But, if you know about him, that he was like a hardcore actual adventurer kind of guy. Like it wasn't just like, oh, I'm a CEO, button down, wear suits to work. Like, no, this guy's like up climbing in the Pyrenees and just doing all this crazy stuff. And like he walked the walk, it wasn't just like BS. Anyway, so one of the things that he talks about in his book is about in falconry, they have this term called Yarrick, Y-A-R-A-K. And be careful with your Google searches there, because it is slang for something you probably don't want to come across. But in this context, the context that we want to use, Yarrick is the state that a bird gets in when hasn't been fed in a couple days. So, if you have a falcon and it's just recently eaten, like you can't get it to do anything, right? It just will not, it won't hunt. It doesn't want to fly. It's not doing anything. But if it hasn't eaten in a couple days, it gets into this state where it becomes hyper alert. And it's like, you can see it in the bird's eyes, like do a Google search of, Falcon, Yarick together, and like, look at this bird. And like, you look at him, you're like, holy shit, this bird would tear me apart if it got the chance, right? It just has that eye of the tiger kind of look in it. And so the important thing is that the bird is hungry, but not to the point of being weakened, right? It's ready to hunt, and it's in its optimal state. And to me, it actually makes a lot of sense that when the chips are down and you're hungry, evolution would have been a forcing function, would say like, okay, well, you have to be at your best right now, like to make it through to the next round, right? Like we can't afford to get so hungry that we become weakened and we can't then provide for ourselves. So this acuity that happens to me makes a ton of sense from an evolutionary selection bias kind of process. So what can we do with that? Like, what does that mean? Well, especially in a small business context, a company that is Yarick, like they're hungry, they're conserving resources, has a very serious advantage. And one of the ways of putting your small business into Yarick is inverting the popular revenue minus expenses equals profits. So that's what we all learn in business school, right? It's almost a cliche at this point. The correct formula there is revenue minus profits equals expenses. So this is almost like pay yourself first as a business, like carve out your profit ahead of time, and then use your expenses that you have available to delight your customer in the way that you best can. You want that forcing function that will unlock the creativity that will allow you to truly provide a great experience, but also guarantee that you're staying profitable and you're keeping your business in Yarick. We can apply the same thing to your personal finances. Automatically saving a certain amount of your income will put your family, yourself, your team in Yarick. And it's not about, like living an austere life necessarily. It's actually about forcing you to examine the expenses that you do have and like run them through the rubric of, is this making me happy? Is this doing what I want it to be doing for me? And if not, then it needs to go. And you won't do that unless you have that forcing function. And the other part that's really nice about it, as someone who's been doing it for a long time, is that the expenses that you do spend, then you can do guilt-free because you know that you're taking care of the future already by saving ahead of time, which is that's a nice place to be. Because I know for me, at least, like I kind of feel guilty spending money often. And there's like a little part of me that likes to deny myself. So, there's Buffett has identified this when he says that a fat wallet is the enemy of superior investment results. And then if we go back even a little further, Cervantes said that hunger is the best sauce, right? Like nothing tastes better than when you're really hungry. So anyway, it's a little falconry term that is kind of fun. And I think actually has some really useful life lessons.
It's a little bit like the capital returns book, where that's something I've written about in Deep Value as well, where I said that what you want is companies that are good at husbanding capital through good times and having it there for the bad times, because that's when they need it to, which is funny given our conversation earlier about carrying cash. But I do think that like this is why it's so hard, right? That you kind of want companies to be holding a little bit of cash, or at least have some firepower and some respect. So when they go through a bad time, they're able to sort of capitalize on it. But then the other side of that, I guess, is that you underperform a little bit through the rest of the cycle. It's a tough business.
Well, there's you can't optimize for both, efficiency in the short term and resiliency in the long term. You have to choose one or the other.
Right.
Well, I think that another kind of segue with that is just how, frugality a lot of times drives innovation, from a company level as well. when you're restrained. I mean, Bezos talks about that, and a bunch of people talk about that.
Why do you think that is?
Well, you're forced to use, you're forced to be innovative and just use the resources that you have, and grind and get a solution. A lot of times the solution you find is probably the most efficient one anyway, when you're forced to have limited resources to some regards. But
do you think that the abundance of venture capital for startup companies, like I think that there's this expectation for many young founders that they're just going to go and raise VC, and therefore you don't need to do anything to kind of get you beyond. You don't need to, any other
ping
sort
pong
of
tables and
straight to the ping pong tables, straight to the nice office. Do you think that makes them less resilient if they start off, well funded?
I mean, I certainly can see that argument that, if you never learn any fiscal discipline, it's going to be difficult when it does get forced on you at some point, whether the market forces it on you through competition or whether outside investor forces it on you because they think that you're pissing the money away. But at the same time, like, what is an expense that is necessary to delighting the customer? And if the ping pong table, I say that jokingly, but like, if the ping pong table builds a culture such that your team is super tight and really works well together and is really happy to come to work every day, and maybe they put in an extra couple hours, well, shit, that ping pong table is a pretty good investment then. So It's not always just clear cut, what's a strategically smart expense and what is a wasteful expense.
I also think that the only kind of VC-backed companies we hear about in the headlines are the ones where just tons of cash are thrown at them. There's plenty of other ones that are successful, that do well, that are frugal as well. He showed up on my Twitter feed. His name's Honam, Honam. If anybody's listening to this, go search him out. Really smart guy. So he's a co-founder of Altos Ventures, and it's about a 10 billion plus venture capital firm. He co-founded in 1996. And they go about venture capital in a completely different way than the norm. They actually go and they take more concentrated portfolios than normal in venture capital. And they look to really help the businesses kind of grow in a pragmatic, capital efficient type manner. Like, they want to get to profitability. And they think it's dangerous to crank up the burn rate, because they think that destroys the culture, of the company when they do that. And they've been wildly successful. I reached out to him through Twitter because he showed up on my Twitter feed. And then I said, hey, do you have 15 minutes to talk? I want to bend your ear. And we ended up spending 2 hours on the phone together. He's just fascinating because he's kind of like Brent Beshore meets VC, and he's been immensely successful in that model. I think they've had 26 companies they've funded that have returned more than the funds that they're in, and like 20 of that returned 3x of the fund. And they just take a more pragmatic approach to venture capital. And they average up into positions over time. Like, he tells a story of, I think, was it Roblox that just went public? It's a $40-50 billion technology company. I think they were the first 1.5 million into that company. And they had to convince the founder and his dad to like take the money. Like, they're like, we don't even need this, but they had to convince him, And so anyway, fascinating person. You should interview him, Toby, on your podcast. But he just thinks through a different lens. And so I think there's a lot of other companies that are kind of like that, backed by people that like Honam, who just do take a pragmatic profitability, frugality type approach. I'd say even to VC.
Is that your model? Do you think of yourself as sort of listed VC, or where do you what's your how do you think about the problem?
I reached out to him because I was curious how the other thing he's done very well is hold for the right tail. Like, I think he's still holding a couple companies for 20 plus years, and not because he's stuck in them, but because they're winners. And he doesn't believe in taking companies public too soon either, because he believes if a company's profitable and growing, he'll find liquidity. There's always going to be a buyer, even as a private company, for a piece of the company.
So the funds don't expire then? Isn't
Well,
that
they
typical?
still they're longer duration funds, and he actually sets up other funds to buy out other interests, SPVs to do some secret. It's really smart how he does it. So I was interested in how he handles just capturing as much of that right tail as possible. And so that was the basis of the conversation and how exactly he did that. And he just kind of went a little bit of detail into that. But I do think there's a lot of similarities to his approach to investing and what I try to do in the public markets, to answer your question, Toby. Yeah.
It's what in this little project that I've been doing where I take these companies from 20 years ago and then just never sell them. It's one of the things that I have observed that they do go through these very long periods of being, often they can be overvalued and they just don't do anything for years, 3 or 5 years, but then ultimately they sort of come back to life. And I don't know, they don't reappear in the screen in that period where they're kind of undervalued and not really working. I think that there's something to that very, very long holding period. You introduce, like Jake and I have talked about it in the past, is like introducing the right tail. It's a way for value guys to get a right tail into their portfolio, because you're no longer holding these things for value reasons. They are, when you buy them, you're buying them because they've had some misstep or they're just not quite appropriately valued. But then there's enough of them that become donuts over a period of time that the Monte Carlo approach to it does make sense. There's a reason why these things are undervalued, because they do have some issues. And I always give the example of Microsoft in like 2011 or 12. 1 year of revenue going backwards, had Steve Ballmer at the helm, about to hand over to Satya Nadella, who nobody really knew about. And the world was in a little bit more flux. And now Microsoft's become a gigantic ripper, but you would have sold way too early if you were, watching the value.
Almost like a left tail buyer and a right tail holder.
Right.
Toby, you interviewed William Green recently, and I think everybody on the planet has his book in front of them. I know I do too. I'm only a couple chapters in, but what was maybe I don't know if you read the whole thing yet, but maybe what were 1 or 2 things that you thought were most interesting out of the book or your conversation with him?
Yeah, I love the fact that a lot of these guys have got probabilistic, data-driven approaches to the market, and then they apply those same rules in their own personal life. And I'll bet if you talk to anybody I'm sure all 3 of us do that. I know JT does it. I was going to talk to him about Yarrick for human beings, because are you still an intermittent faster, JT? You still do that?
Yeah, that's my Yarrick applies to the human biology as well, and definitely feel better when I have periods where I'm and in fact, like if I have something really important, like mentally, that I want to optimize for, I want to go into it in a pretty fasted state.
How long is a fasted state for you? 18 hours or longer than that?
Yeah, typical like run rate day is 18. But for that, if it's something, depends on what time it is, and sort of if I want to eat or not. But it could be a whole day pretty easily if I wanted, and I'll feel pretty damn sharp and good going into it.
Yeah, I think it's interesting to see how folks take the insights that they get from the markets, which are basically just it's just human psychology or human interaction, sociability, and then apply that in their personal life. Because there's a lot of, I think William Green writes about this a little bit, that there are a lot of guys who have the low EQ, and that seems to help them in an investing context, because they're happy to be apart from the herd. But then I know a lot of guys who've got very high self-awareness who also seem to do quite well in the markets. And I think that the self-awareness helps them when they're underperforming or something like that, or they're able to understand the motivations or the movements for. And I think that someone like Bill Miller's story is interesting. I don't know if I always sort of wasn't quite as aware of the story as I am now that I've chatted to William about it. But I love that he had that very long period of time, 15 years or something, where he beat the market and he outperformed. And then he had some years in the wilderness where he didn't do very well, changed firms, had the big position in Kodak that he bought all the way down. It's kind of must have been psychologically quite difficult. And then to see him sort of turn that around, and the way that he, he's very, very successful now, and he's still got that same kind of, I think he's got a stoic sort of approach to the market where it doesn't really bother him anymore. I found that really, really compelling. I think that's an important thing. Like as William was talking, I was like, this is all the sort of stuff that I want to put in my new book, or this is the stuff that I've been researching for the book, and it's interesting to hear it in the context of many other investors, because I'm doing it explicitly in the context of Buffett, because I think that he definitely possessed some of these ideas. So I think, there's a lot to the having some sort of philosophy outside of the markets that seems to be helpful. Have you read the book?
I read the first 2 chapters, so I got through Monish and Templeton, and it was interesting. So, I was reading about Monish, and I remember it brought up a memory. And there was a part in the book. Actually, I have it here. I'm gonna bore everybody watching me page through a book, but there was a part in the book where Monish was talking where he was describing Monish and how, like, he's very guarded with his time. And he'll meet with somebody once, and then he'll evaluate the person if they were worthwhile or they were additive to his life or not. And if they aren't, he has no problem just not seeing them again. That type of thing. And he believes in he's a clone of Buffett, so he believes in having a clear schedule, not having any appointments and things like that. And I remember, so a friend of mine, who's a well-known investor, so the summit that Microcap Club puts on, it's usually in September in Chicago every year, and it almost always coincides with Monish's annual meeting he has for his fund. And
are they on the West Coast? Where does he host that?
He usually has it in Chicago.
Okay.
He has 2, one in Irvine and one in Chicago.
One in Chicago.
Okay.
And so I thought, okay, well, if our event's going to be there, maybe I could just swing by and, listen to it or whatever. And so, but I'd never talked to Monish before. And so I had a friend of mine who I knew him, email him, do an email introduction for me. And he made the email introduction, and then I should pull up the email. I forget exactly what it said, but he emailed me back something like, I try to keep a clear schedule. If there's something worthwhile to talk about, let me know. And that was like that. And I kind of sat me back. I was like, oh, okay. And I was like,
I don't have anything.
My first inclination was, well, I'm sorry to waste your time, pal. But I just said, after a while, I kind of sat back and reflected on that, about how guarded he was with his time. And I was like, that's pretty cool. In some ways that I could see, and he realizes that probably rubs people the wrong way, but it's just how he kind of probably has walls up around his life and his time, so he can focus on the things he want to focus on. But anyway.
Paul Graham has this great article where he talks about, I think it's the maker calendar versus maybe the manager calendar. And he says that because it takes, deep work like writing or something like that it takes a long time to get yourself into the state where you can do it. So you need to, if you're writing, you need to read what you've written beforehand to get yourself into the state that you know what you're talking about. And if you're interrupted through that process, it's hard to get any kind of flow on. So Paul Graham recommended that maker calendar should be like the morning is empty or the afternoon is empty. Like you need an entire block where you don't schedule calls. And I try to do that too, because I get lots of people who want, I just need 15 minutes of time, but the 15 minutes breaks up a maker block for me. And so it's 15 minutes is as bad as an hour. So I try to concentrate all the calls that I have to do in the same time that I've got other stuff where I'm being interrupted. I found that to be a useful thing, but there's a lot of people who want 15 minutes, and it's just hard to give 15 to every single person.
2 hours.
Yeah, well, then there's that's the thing that you miss out on, right? That sort of serendipitous meeting of someone who's interesting and can help.
I think it's a commonality probably in a lot of people. I know a friend of mine, Yen Liao, of Aravat, he's the same way. Like he doesn't schedule any meetings before noon. And I'm the same way too. Like I'm more of a morning person, so that's my creativity phase.
It's when you work.
Yeah, a little bit before the kids get up. So call it 5 a.m. to 7 a.m., 8 a.m. Crank a couple cups of coffee, and I start writing, journaling, thinking, that type of thing. And now that I have 2 young kids, that, my window is about an hour.
Yeah.
My writing suffered.
Yeah.
There's not nearly as much journaling anymore. Let's put it that way. But I can certainly see why, kind of siloing those parts of the day are important. And for me too, like I get, like even for this podcast, I same as Jake, like I haven't eaten today, and it's 1:00 Eastern over here, just because I feel like I'm more alert, when I do something like this. So I definitely.
I see that Yorick in your eyes, Ian.
That's right. I'm ready to attack. Ready to hunt.
Are you an intermittent faster?
I'm not, but I do enjoy denying myself of things from time to time. Like there's usually a couple months a year where I just won't drink alcohol, just to not drink alcohol. I don't go over and above. I don't go extreme with it, but from time to time, I like to get rid of things just to show myself that I can.
Yeah.
Weird like that.
You always want to do that in February because it is the shortest month.
Yeah.
Oh, I did it
28 days.
Last year. I did the non-drinking thing it was December. So over holidays, it was December and January, and I wanted to test myself because it was over the holidays and my birthday and New Year's Eve. And I was just
real denial.
It was tough. Yeah.
Did it work?
I made it.
Did you lose weight? Did you noticeably lose weight or anything like that?
A little bit. I definitely felt better.
Yeah.
A lot better. It's amazing just how, just more alert I am. And you're like, well, why do you go back to drinking? Well, I still like to enjoy having a beer every now and then. But it is what it is.
We're sort of coming up on time, amigos. Throw a question in. We'll see if we can do a question. We might be just about out of time. It's been fun having you here, Ian. You're joining us next week as well.
Yep, I'll be back. I'm getting my second vaccine shot on Sunday, so I should be
so
back.
You might not be back.
Ready to go.
Yeah, exactly. I might be a little more lethargic, so I'll just be sitting here in a stupor. But looking forward to it.
That'll be really fun. Look forward to seeing you again. Amigos, that's time. So we'll catch everybody next week. I'm going to try to stop broadcasting. Here we go. Let me see if I can do this.